In order to truly determine whether a capital investment is a good idea or not, we want the present value of future cash flows. So we are going to discount the future cash flows back to the present value. We need to know what the amount of the future cash flow is, the length of time that we have to wait to receive the cash flow, and the rate of return required by our company. We use the time value of money concept. So with the time value of money concept, we know that a dollar received today is worth more than a dollar received in the future. And that is because we can invest that dollar earned today and collect interest on it. So money earns interest over time, which is the time value of money. Capital investment analysis that uses the time value of money are the net present value method and the internal rate of return method. We need a lot of information to create this. First, we need to know what the principal amount is for single lump sum, the amount of the investment that we're paying out. Then we need to know the number of time periods from the beginning date of the investment until the investment ends. What's the life of this investment? And then we need to know what the interest rate, so the annual percentage earned on the investment. We look at the future value and present value factor tables. So there are four time value of money tables. Present value of one, which is the value today of a lump sum in the future, and the present value of an ordinary annuity of one. So this is the value of a series of equal future amounts or annuities. So if we have annual cash flows in a capital investment project, that is considered an annuity. We generally don't use the future value tables for capital investing decisions. Those are most useful for determining future payouts or what the future value of things like a retirement account would be if you put away a certain amount of money every month. Net present value method is capital investment analysis method. We look at the difference between the present value of the cash flows and the actual cost of the investment. The rate we use is the company's desired rate of return. This is usually called either a discount rate or a hurdle rate, but they're the same thing. We use the present value tables, and you can see an example of this table. So we have the number of periods for the investment. So for example, the vending machine investment is a 5-year investment. That's the life of those vending machines. So we would have 5 number of periods. And then if we had a 10% required return on investment, we would go over to 10% and we would take our yearly or cash flows times this rate of 6.21. So then we also have the time periods times the future. So this is for our annuity, our annual cash flows. This is for our, and the examples that we do in class will be utilizing Excel, and Excel has built-in functions for net present value and the internal rate of return that don't rely on the present value tables. The discount rate is our required rate of return. So now we're going to look back at our vending machine problem and see if we hit those future cash flows. If our amount is positive when we do the net present value calculation, that means that the project's desired rate of return is higher than our minimum rate of return. If the value is negative, that means we're not going to meet our required rate of return and we would probably reject the project. So we have a 15% annual rate of return. We have 10 vending machines that are expected to generate annual net cash flows of $24,000 a year for 5 years. The present value of 1 to be received annually for 5 years, discounted at 15%, is 3.352, as we can see on this table. So 5 years, 15%, 3.352. So the present value of that $24,000 received annually for 5 years is $80,448. In addition to these cash flows, we're going to receive the $5,000 salvage value at the end of useful life. The present value of 1 to be received in 5 years, discounted at 15%, is 0.497. So the present value of $5,000 is $2,485. So we add the present value of our annual cash flow plus the present value of the proceeds from disposal to get the total present value of the investment's cash flows. Then we subtract the cost of investment and we get what the net present value of the investment is. This is a positive number, so it shows that the investment is expected to provide a rate greater than that required 15% rate of return. If that amount had been negative, we would have received less than a 15% return, and if the value was 0, that rate of return on the investment would have been equal to the 15% required. This is just a breakdown of whether we accept or reject. So if it equals 0 or is above 0, we can accept the project. If it's below 0, we would reject the project. Other non-financial issues we need to consider is Vendicorp going to maintain its stock before each game? So what is their maintenance going to be like? What is the stock going to be like? Are we going to run out and have issues? Have we obtained bids from other suppliers of vending machines? If we decide we're going to go that route, we might want to consider getting a few more bids. And the other option is to use an outside catering service instead of having an internal catering service. We also have other things we could do with that money. We already said one of the things that they were looking at was buying a new bus. What if they need new stadium seats or other things that they can do to generate income? When we have limited funds, as they explain, this baseball team has a limited funds. When we have limited funds, we have to have and we have multiple different things that we can invest our money in. We have to make hard decisions about which investment and when. A lot of capital investment decisions involve the replacement of existing assets. So, for example, replacing that new bus. So we have relevant information and incremental analysis. Remember, that was our decision-making process from previous chapters, where we had what is a sunk cost versus what is a relevant cost, relevant incomes, and then what is the difference between the two decisions and our incremental finance information. We need to discount our future cash flows. We're going to look at income tax effects, and then we would have any non-financial factors that would be considered. So now we're going to look at that bus replacement investment opportunity. Remember, we only have $75,000 to invest. We have to choose the bus or the vending machine. Our bus is old, it's expensive to repair, there's no air conditioning, has all kinds of problems. So we can buy another bus that's larger, has air conditioning, and is more fuel efficient. The new bus is $65,000. the book value of our existing bus is $25,000, but we can only sell it for $10,000. So we're going to take a loss on its sale. We have estimated annual operating costs of $18,000 for the new bus and $30,000 for the old bus. So the old bus has a book value of $25,000, but a current sales value of only $10,000. That $15,000 loss could be an argument against replacing the old bus, but because the cost of the old bus is a sunk cost, that doesn't become relevant to this decision. What does become relevant to the decision is the fact that taking a $15,000 loss can save us on income tax expenses because we'll get tax buffer from that $15,000 loss. So when we're trying to decide what the present value of these cash flows is, we have to decide what the cash flow increase is. So we're going to have a $12,000 annual savings in operating costs. And I say, wait a second, where did you get that $12,000? That is because the existing bus cost us $30,000. The new bus is going to cost us $18,000. So the savings is the difference between that $30,000 and that $18,000. So the incremental cost, the difference, that $12,000. We also have the annual depreciation on the old bus versus annual depreciation on the new bus. So there's going to be an $8,000 increase in depreciation expense. So we're going to increase taxable income by $4,000 per year. So we have $12,000 annual cost savings less $8,000 in additional depreciation expense. So we can look at these cash flows. If we have a 40% tax rate, we're going to increase our annual income tax expense by $1,600. Therefore, incremental annual net cash flows amount to $10,400. So we have the $12,000 savings in operating costs less an addition on income taxes. We calculate the present value of those cash flows by using the factors in the times table. So now we can look at the present value. So our present value of the annual cash flows are $34,861. We're also going to get $10,000 from selling our old bus, and we're going to get tax savings from that $15,000 loss, which gives us a total present value of this investment of $50,081. Now the net present value is negative on this investment. It will not meet our required return on capital investments of 15%. But now we have to think about the non-financial considerations. So just because it doesn't meet the desired rate of return doesn't mean it should be rejected. So we have morale of the team, we have better reliability because the old bus frequently breaks down. We're going to potentially save on a lot of repair expense that we can't guess. And that negative $15,000 doesn't seem like an impediment to the improved comfort and reliability that a new bus would provide. The behavioral considerations in capital budgeting are, of course, because we're frequently evaluated on outcomes that happened because of our decisions. Our performance evaluation, yearly evaluations, etc., can happen because we made decisions. And making capital and budget decisions can get our company locked into expensive things that we can't get out of. We usually have to have input from a lot of different people. We need to make sure we have extremely reliable estimates, and we usually have some kind of internal controls to help against um, having overly optimistic or pessimistic estimates. So we might make our estimates with budgetary slack, if you remember that, and we don't want that to happen in capital budgeting. We don't want there to be any room for slack, either positive or negative slack. At the end of a capital budgeting project, we would have an audit, and we generally keep track of them as they're being implemented. So we look at percentage of completion as it's going through, the projected expenditures versus the current cash flows that are coming in. We might have, like, if we're building a building from scratch and it's going to take an extended period of time to build that, we might do a monthly capital budget audit to look at percentage that it's currently complete, the cost that we've currently spent on it, and what that looks like compared to our actual schedule, plan, and budget for this capital investment. And that is the end of chapter 26. And the last chapter for Accounting 122 this semester.